Imagine someone gives you $1,000 today and tells you that one decision could completely change your financial future. Would you invest it in crypto, hoping for explosive returns? Or would you choose the stock market, where wealth has quietly been built for generations? Here's the surprising part: most people lose money not because they picked the wrong investment, but because they invested for the wrong reason. And that's exactly why millions of beginners in 2026 are still asking the same question: crypto or stocks? Before you invest your first dollar, there's something you need to understand because it could save you thousands. Meet the investor, a 32-year-old businessman who has spent years studying how ordinary people build wealth. Whenever someone asks him where to invest their first $1,000, he never answers immediately. Instead, he asks a different question. What are you trying to achieve? Most people are surprised because they are expecting the name of a stock or the next cryptocurrency. But the investor knows that investing isn't about chasing trends. It's about choosing the right tool for the right goal. Now let's meet two friends, Alex and Ryan. They both worked hard and finally saved their first $1,000. Alex couldn't stop watching videos about crypto. Every day he saw people posting screenshots of huge profits, claiming certain coins would make ordinary people rich overnight. The fear of missing out became so strong that he felt waiting even one more day would be a mistake. Ryan, on the other hand, ignored the hype. He spent his time learning how successful investors had built wealth over decades. Instead of looking for the fastest way to get rich, he looked for the safest way to stay invested. On the same day, Alex invested all $1,000 into a popular cryptocurrency, while Ryan bought a diversified global stock index fund. At first, Alex looked like the winner. Within weeks, his investment jumped nearly 40%. Friends congratulated him, and social media made him feel like a financial genius. Ryan's portfolio barely moved. It felt boring, and for a moment even he wondered if he had made the wrong decision. But here's what nobody tells you. The first few weeks of an investment can be the most dangerous because quick profits often create overconfidence. When prices rise, people believe they'll keep rising forever. That's when emotions quietly take control of financial decisions. Then everything changed. Unexpected negative news hit the market, and panic spread quickly. Crypto prices started falling. Alex watched his profits disappear, then his original investment, and finally, a large part of his savings. Every time he opened his phone, the numbers were lower than before. Fear replaced excitement almost overnight. Ryan's portfolio also dropped because stock markets don't move in a straight line either. But unlike Alex, he wasn't surprised. He knew market declines were normal, and because his money was spread across hundreds of companies, he wasn't depending on the success of a single investment. Instead of selling, he simply stayed patient. This is where most people fail. They think successful investing is about finding the perfect asset. In reality, it's about controlling your emotions when markets don't go your way. And what happened next completely changed the way both friends thought about money. Over the next few months, the difference between Alex and Ryan became much bigger. Alex checked his portfolio every few minutes, hoping the market would recover. Some days his crypto jumped 15%, only to fall even further the next day. The constant ups and downs affected more than his money, it affected his confidence. Eventually, fear took over, and he sold his investment at a loss. Ironically, a few weeks later, the price started rising again. Alex didn't lose because crypto existed. He lost because he let emotions make his decisions. Ryan's experience was very different. His portfolio wasn't exciting, but he understood something most beginners don't. He wasn't trying to predict tomorrow's market. He was investing in businesses that continued selling products, earning profits, and growing over time. Instead of watching charts all day, he focused on increasing his income and continued investing a little every month. Slowly, his portfolio began recovering. But here's what nobody tells you. The biggest difference between successful investors and unsuccessful ones isn't intelligence, it's patience. Most people want extraordinary results immediately, while wealth is usually built through ordinary decisions repeated consistently for years. History proves this again and again. Every market has gone through periods of fear, uncertainty, and sharp declines. The investors who panicked often locked in their losses. The investors who stayed disciplined gave their money time to recover and grow. That's the power of long-term investing, and it's something social media rarely talks about because patience isn't as exciting as overnight success. Now, here's the twist that changes everything. Most beginners ask, which investment will make me the most money? But experienced investors ask a completely different question. How much risk am I comfortable taking? That single question changes every decision you make. Think of your investments like building a house. The foundation has to be strong before you build higher floors. For many people, diversified stock index funds become that foundation because they spread risk across hundreds of companies. Crypto can be an additional layer with higher growth potential, but if your entire financial future depends on one highly volatile asset, you're taking a bigger gamble than you may realize. The truth is, this isn't a battle between crypto and stocks. It's a battle between discipline and emotion. And the people who win aren't always the ones who find the highest returns. They're the ones who stay invested long enough for those returns to matter. So, if neither crypto nor stocks is the complete answer, what should you actually do with your first $1,000? That's where everything finally comes together. So, where should your first $1,000 go? After everything we've discussed, the answer should be much clearer. The investor doesn't believe in chasing the perfect investment. He believes in building a system that works no matter what the market does. That's because markets will always change, but good investing habits never go out of style. The first step is to build a strong foundation. If you're just starting your investing journey, diversified stock index funds or ETFs are often a smart place to begin. Instead of relying on one company or one industry, your money is spread across hundreds of businesses. Some companies will struggle, others will grow, but together, they create a portfolio that's designed for long-term wealth, not overnight riches. The second step is to take calculated risks. If you believe cryptocurrency has a bright future, there's nothing wrong with investing in it. The mistake is putting all your money into one highly volatile asset. Think of crypto as an opportunity to increase potential returns, not as your entire financial plan. If it performs well, your portfolio benefits. If it experiences a major crash, you still have a strong foundation supporting your future. The third step is the one almost everyone underestimates: consistency. The market will have good years and bad years. Headlines will constantly tell you to buy, sell, or panic. But successful investors don't change their strategy every time the news changes. They continue investing month after month because they understand that time in the market is usually more powerful than trying to perfectly time the market. But here's what nobody tells you. Your greatest investment isn't your first $1,000. It's your ability to keep investing year after year. Imagine investing just a few $100s every month for the next 10 or 20 years. Thanks to the power of compounding, your money doesn't just grow. It starts generating returns on its own returns. That's how ordinary investors quietly build extraordinary wealth. There's another lesson that many beginners completely overlook. They spend months searching for the next coin that could double in value while ignoring something they have far more control over: earning more money. Learning high-income skills, improving your career, starting a side business, and avoiding unnecessary debt can increase the amount you invest every single month. And over time, increasing your monthly investments often has a bigger impact than finding one lucky investment. So, crypto or stocks? The truth is, you don't have to choose one forever. Stocks provide stability, diversification, and a proven path to long-term wealth. Crypto offers innovation and the potential for higher returns, but it also comes with much greater volatility. The smartest investors understand the strengths and weaknesses of both instead of blindly following trends. If your first $1,000 represents months of hard work, don't let hype decide where it goes. Let knowledge decide. Build your foundation first, take calculated risks second, and stay consistent no matter what the market is doing. Because at the end of the day, wealth isn't built by predicting the future. It's built by making smart financial decisions repeatedly, staying patient when others panic, and giving your investments the one thing they need most: time. Remember this. Wealth isn't created by finding the perfect investment. It's created by making smart financial decisions over and over again. Whether you choose crypto, stocks, or a combination of both, your future won't be decided by one investment. It will be decided by your discipline, your patience, and your consistency. Money doesn't change your life. Your financial decisions do.